Okay. Good morning, everyone. So we commence our discussion on Ind AS 102. So we are having, we'll just write a couple of points on what we have discussed so far, and then we shall continue with the remainder of the standard. Today we will be extending a little bit, say by about half an hour or so. Okay. So let us start. First of all, in the last class, we discussed equity settled plans, that is ESOPs, as well as we discussed cash settled plans, that is payments made, which is dependent on the share price of the entity. So basically, your payments may be made by the entity for goods or services received either in the form of its own shares or based on cash consideration dependent on the price of its own shares. So this is basically what we call as cash settled. Okay. So broadly, your share based payments can be classified into two segments. First one is, I'm just recapping what we have done, and you can also take down these notes so that it's just a summary. And you have cash settled plans. So this is example employee stock option plans. This is example SAR, stock appreciation rights. Good morning, Soham. Good morning, Rashmi. Good morning, Manini. Good morning, Sumit. Okay, so you have this ones. So basically, what is the difference here? First one is settlement happens in own equity shares. Own equity shares. Whereas here, settlement happens in what? Settlement happens in cash. Then, sir, why is it covered under share-based payments? But based on entity's own share price. So that is why we are covering it under share-based payments. It is not saying only stock option plan, or it is not saying equity settled share-based payments. The standard talks in general about share-based payments. Okay, so this is the first difference between cash settled and equity settled. The second one was in terms of accounting. If you recollect, SBP reserve to be created. Where would I show this reserve? Presented under other equity. Other equity in the balance sheet. Presented under other equity in the balance sheet. Whereas here, what would you be creating? SBP liability. SBP liability to be created. Sir, why is it a liability? Well, it is a liability because it is an obligation to deliver cash. SBP liability to be created, presented under current or non-current liabilities. Depending on when the payment becomes due, you present it under current or non-current liabilities in the balance sheet. Okay. Obviously, SBP reserve, the alternative name could be stock options outstanding. Okay, so that is just for your information. The third category of difference, the third broad difference is in the case of equity settled plans, do we do a remeasurement? Answer is no. We do not do a remeasurement. What we do is basically price it at the fair value at the grant date and do the entire accounting based on the fair value at the grant date. Okay. So measurement, you can write this in the initial pages that we had left. Measurement at fair value as on grant date. As on grant date. Important thing to remember is no subsequent revaluation. Sir, why no subsequent revaluation? Because SPP reserve sits under other equity, which is part of my equity, and own equity can never be revalued as per GAAP principles. Okay, so this is no subsequent revaluation. Third point here is, can you revalue this? Yes. Measurement at fair value at each balance sheet date. At each balance sheet date. Mandatory revaluation. Why would you need to revalue this? Sir, this is because this is a liability. This is not an equity. Okay. So we can just write that small logic and then we are done with the summary. Own equity cannot be remeasured. And here liability needs to be revalued. Okay, so this is a short summary of what we have already covered in the previous session. Initially, we'll write a couple of pointers. Okay, before we move on to the next part. Good morning, Gauri Shankar Rao. Good morning, Hari. Once you are done, just let me know. Once you are done, you can either take a screenshot and just park it when you may write later on. Okay. Done. Okay. Good morning, Rakesh. Yes. All right. So it's done. So then we move on to accounting for, we had started up with this. Accounting for employees' share-based payments. This was what we had started. Under accounting for share-based payments, we had discussed some key terms. What are my key terms? Well, I have first discussed what is the grant date. Okay, I have discussed what is the grant date. Thereafter, I have discussed what is the vesting period. Vesting period is that period in which your options vest in the employee. So vesting period. Then we discussed the third thing, that is exercise period. Exercise period. Then we discussed something known as fair value, which is basically the value determined using an option pricing model, We also discussed something about intrinsic value. So for fair value, you can write forward looking value. Forward looking value based on option pricing models. Option pricing models. Okay, intrinsic value is nothing but current market price minus exercise price. Exercise price. So your options will always be calculated based on the fair value, not the intrinsic value. Okay, intrinsic value was a concept for share-based payments, employee stock option plan accounting under the previous guidance note. But ये तो मेरा कोई requirement नहीं है यहाँ पे. Here the accounting for employee stock option plan will happen based on the intrinsic value. All these definitions are there in the presentation which I have shared with you. Okay, which I have shared with you. Okay, so you can just write here accounting for share-based payments. Share-based payments, that is booking of employee benefit expense, is always at fair value under Ind AS 102. Under Ind AS 102. Reason being, we have written already, fair value is a forward looking value. That is why we take that. Whereas because the services are yet to be provided generally, unless it is immediate vesting. Okay. So are you kind of able to recollect what we have done so far? Yes. So let me know if you have just noted this part down. Yeah. If you have just noted this, let me know. Quickly complete this, then we move on to market-based conditions, non-market conditions. Done? Okay, so Manini has confirmed. Rakesh, Hari, Rashmi Kamath, Gauri Shankar Rao, Soham. Are we done? Sumit? Okay, all right, great. So that takes care of this part, employees share-based payments. Then if you look at employees share-based payments, we are basically concerned with two things. Timing. When I say timing, it is basically when to book EBE. When to book the employee benefit expenses. And the next one is measurement. Basically, you look at the journal entry, you need two things. One is date column में क्या लिखना है, what date to put, and the next one is कितना, at what amount. Okay, measurement. What is amount of EBE? Okay. So here, it depends on the vesting conditions. Okay. So immediately vested. Immediate vesting. Record entire EBE immediately on grant date. Sir, why immediately? Well, they have vested. The moment your plan is announced, the options have vested in you. Okay, so essentially this is like a compensation for a past service. Okay, compensation for past service. Compensation for past service. Okay, so immediate vesting, this is what happens. In the other case, gradual vesting. Gradual means what? It happens over the vesting period. So record EBE, record employee benefit expenses. How are you going to record this? Record EBE over the vesting period on a straight line basis. On a straight line basis. If you remember, we used to prorate it 1 by 3, 2 by 3, 3 by 3. Yes, deduct what was previously accounted and record the expenditure for the current year. तो वही करना है अपने को. Okay. Measurement. Well, this would happen at the fair value of the options as on the grant date. Okay. Fair value of options allotted. Fair value of options allotted. Okay. Why do I take fair value? Because it is not possible for calculating the fair value of the services received. Because it is not possible for calculating fair value of services received for employee. You can just write that down as measuring fair value of services received from employees cannot be measured reliably. Cannot be measured reliably. Okay. So in the case of ESOPs and in the case of SAR, fair value at grant date. Fair value at grant date. This will be fair value at each balance sheet date. At each balance sheet date. Okay. So just note this down. Once you are done, let me know. Okay. Once you are done, just let me know. We have done all this. I had told you I'll just be giving you the notes in today's class. So it kind of refreshes your memories also. Okay, so Manini has confirmed. Others, have you taken a screenshot, noted down, whatever you call it? Have you done this? Done. Rakesh has confirmed. Soham, Gauri Shankar Rao, Sumit, Aniket Jain, if you're there, Hari. Sandhya Gauri has not joined today. Srishti Goyal, Rashmi Kamath has confirmed. Okay, done. All right. So that is done. Well, so this takes care of when to book and at what value to book the expenses. One thing we can write is here, one extra thing we can write is measurement is also based on number of employees expected to remain in service at the end of the vesting period. Important is number of employees expected to remain in service. Okay, so that is important. All right, that is important. So just for your indicator, you can write possible management bias. Possible management bias. See, it's a bad year. I have to save wherever I can to present a favorable result. So what I will tell, itne employee rahenge hi nahi. And if so many employees do not remain, my EB automatically will come down. So therefore, there is a chance that management bias can be seen in these estimates. Okay, so that is how the accounting happens. Okay, so if you have written this down, we then move on to the next part. Okay, that is journal entries for stock options. We have already done it, but just for the theory, vesting period, we pass the entry employee benefit expense, which ultimately moves to the P&L, to SBP reserve. Where are you going to show this? Other equity. In balance sheet. Other equity in balance sheet. Okay. So typically, see, there would be a second entry P&L account debit to employee benefit expense, but that is more of a common sense. Okay, so I have just written P&L. Of course, it depends on even other things, like suppose these employees are constructing a capital asset, then this expense will move to the capital asset. Okay, in line with Ind AS 16, of course, but that is like common sense. So I'm not stressing much on that. Okay. Exercise period. Exercise period. All right. So under your exercise period, what is the entry that you are going to pass? Well, employee will exercise, so he will pay the exercise price. Okay. So bank account debit. SBP reserve debit. To equity share capital. To securities premium. Okay. Just a minute, please. Just a minute. Something is there at the home. Just give me a minute. Sorry for the disruption. There has been a snake in the house, so it's kind of crazy. Okay, all right, it's still there, but people are hopefully looking after. Okay, all right. Okay, so you're having exercise period, bank account debit, SBP reserve debit to equity share capital to securities premium. This is the entry in the exercise period. All right, what if your options lapse? Okay, this is in respect of options exercised. And then you're having another entry that is options lapsed. The entry is going to be the reserve balance, SBP reserve debit to retained earnings. This is in respect of options lapsed. Okay, so that takes care of the ESOPs. We've already written that it's based on number of employees, and it is also based on what you can say, the fair value at the grant date. All these things are already written. Okay, so that takes care of this. And finally, we move on to the SAR. Okay, journal entries for share appreciation rights. So vesting period, the entry is going to be employee benefit expense, which ultimately goes to the P&L, debit to SBP. What is this going to be, sir? This is going to be liability. This is going to be liability, not reserve. This is going to be a liability. Okay, and ultimately the expense is transferred to P&L. It may go to an asset if it is for constructing an asset. Okay, exercise period. Exercise period, the entry is SBP liability, SBP liability debit to bank, Okay, all right. When I talk about exercise, what am I going to give my employees? Am I going to give entire cash? Am I going to give cash minus fair value, or am I going to give cash minus exercise price? I'm going to give cash minus exercise price. So this is going to be, market price. That is current market price, not cash. Current market price minus exercise price. So what is important to understand is when your options are going to be settled, when these stock appreciation rights are going to be settled, the employee comes to you with that appreciation right, and then it tells, look, you have given me a paper जिसमें लिखा है I will pay, the company will pay the employee depending on the differential between the exercise price and the market price. So market price right now is 100. My exercise price is 40. So now give me 60 rupees. In the case of stock options, the story would go something like this. Okay, we had discussed this. I'm just telling you. In the case of ESOPs, employee pays, let us assume exercise price 40, gets a share of 100. Then he can do whatever he wants. He can sell directly in the market and make a 60 rupees gain, or he can keep the share for 100 rupees if he thinks the company share will appreciate in the future. In the case of SAR, employee will not pay anything to the company. In the case of SAR, employee will have that piece of paper that entitles him to the stock appreciation, right? He comes to the company and tells, look, you have given me this paper where you have said that you will pay me for the incremental. So the exercise price is 40, current market price is 100. So company pays the differential, that is 60. That's it. The story is over. So for ESOPs, the employee to exercise the ESOPs, you know what is going to happen? The employee first needs cash in his pocket to get the benefit of an ESOP. Whereas in the case of SAR, usko nahi chahiye. He will be getting the cash. He does not have to have 40 rupees. For ESOPs, the employee should pay 40 to get 100. Whereas in the case of SAR, the company will pay 60. Employee will not pay anything. What is this 60? This is nothing but 100 minus 40. This is nothing but 100 minus 40. Okay, so this takes care of your accounting. Okay, so this is nothing but intrinsic value. So settlement will always happen. Settlement will always happen at intrinsic value. And this is the only place where intrinsic value is being used. Otherwise, nowhere you are having intrinsic value. Okay. In the case of lapse, the entry is going to be SBP liability. SBP liability debit. Sir, where this will go? This goes to the P&L. It is like a liability written back. Lapse. Similar to liability written back. Similar to liability written back. Similar to liability written back. Okay. This will not go to reserves because it pehle equity mein gaya hi nahi. It was not an equity. It was just coming in as a liability. So therefore SPP liability to P&L. Okay. So here also it will be based on number of employees expected to vest at the end. You will present it as current or non-current liabilities. We have already written that. It will be remeasured. Okay, so remeasuring will happen at the end of each balance sheet date, and the payment would be based on intrinsic values. So that is done. All right. Now, suppose at the end of the vesting period is done, you are in the exercise period. Suppose the exercise period is 3 years. End of year 1, nobody exercises. You will still do the fair valuation and take the movement in the fair value. You will still take the movement in the fair value. Okay, so unexercised options also would be fair valued in the exercise period also. So don't forget that. So we'll just write that part down. Unexercised options not yet lapsed will continue to be restated at the fair value. At the fair value. Unexercised options not yet lapsed will continue to be restated at the fair value even in the exercise period until the options get exercised or lapsed. Get exercised or lapsed. So in दोनों के केस में you will do the fair valuation. You will do the fair valuation. So we've done all this. We have solved through the 3-4 questions. So there is absolutely nothing that I have discussed new. I have just summarized the points and given to you in writing. Is it okay? Are you guys able to recollect and able to understand? Yes. Are you able to follow? Any doubts so far? Any doubts? No doubts? So let us proceed to the next question. Let us proceed to the next question. Okay. So now I think we are having a new November 2022 question. 1 second, let me just search it. Okay, so this is the question. Okay, now this ideally is not what you can say, this question was not there in your study module, but this is the older syllabus question. Principles remain the same. There is no change in the principles. So we shall just do the accounting accordingly. Okay. Sir, what if there is a significant rise or a decline in fair value of shares in the middle of the year? Is interim restatement needed unless it is a stock appreciation right? No interim restatement is needed. Okay. If it is a stock option plan where you allot shares, no restatement would be needed. Okay, so now let us come to this question. This question talks about something known as graded vesting. So question padhenge, we will understand what it is, and then we shall proceed to solve. This is your November 22 RTP question, but this was also there in the earlier syllabus. Okay, so following particulars in respect of stock options granted by an entity are available. Number of employees covered is 400. Number of options per employee 60. Nominal value per share is 100 and exercise price per share is 125. Nominal value is typically your face value. Okay, not fair value, face value. Shares offered were put in 3 groups. Group 1 for 20% shares offered with vesting period 1 year. Group 2 for 40% shares offered with vesting period 2 years. Group 3 for 40% of shares offered with vesting period of 3 years. Fair value of the option on the per share on the grant date was rupees 10 for group 1, rupees 12.5 for group 2 and rupees 14 for group 3. Sir, what is happening here? Well, there is just one plan. The plan has a life of 3 years, but employees would tell, sir, आप 3 साल का commitment मांगते हो. Who knows what happens in 3 years? We may be there, we may not be there. You want us to work in the same manner, in the same way for the entire 3-year period, and suddenly at the end of 3 years period, you are going to give us the benefit, which is not practical. Give us something to motivate every year. So what the management tells is, all right, we will give you one plan only. Out of that one plan, 20% of shares in that plan will be vesting at the end of the first year. 40% of the shares will vest at the end of the second year, and remaining 40% will vest. So basically, it is one plan, which is vesting in a gradual manner. Okay, which is vesting. Suppose 100 shares were given, 20 vest at the end of the first year. That means, suppose in the second year employee chhod ke chala jayega, he can exercise the option for 20 shares. He can exercise the option for 20 shares. 2 saal baad chhod ke gaya, he leaves after 2 years, 20 plus 40, 60 shares vest in him. Remaining 40 will lapse because he leaves in the third year. If he leaves at the end of 3 years, entire 100 shares have vested, he can exercise and he can exercise all the entire 100 shares. So this is the meaning of graded vesting. Graded vesting means vesting happens in a phased manner. Okay. We'll write a small note for this in the theory, but first we'll proceed to solve the question. So how do we do this? Well, very simple. Treat each vesting, each group as separate plans and do the accounting. Treat each of them as separate plans and do the accounting. So what is given? Position in the first year, number of employees left is 40, estimate of employees to leave in year 2 is 36, estimate of employees to leave in year 3 is 34, employees exercising options in group 1 is 350. Position in the second year, 35 left, estimate of employees to leave in year 3 is 30, employees exercising the options is 319. Position in the third year, employees left is 28, at the end of the last vesting period 297, whereas exercising the option is 295. Options not exercised immediately on vesting were forfeited. Compute the expenses to be recognized each year. Show the important accounts in the books of the company. Show the important accounts in the books of the company. Okay. So let us start solving this question. You can mark it as important because ये पहली बार आया है. Okay. So you can mark it as important and let us proceed to calculate the expenses. Okay. So how many options am I given? Sir, I am given 60 options per employee. Okay. So you are having 60 options. This is November 22 RTP. 60 options. What do I do with this 60 options? Well, they are vesting in a phased manner. So you are having plan 1, plan 2, plan 3. Vesting is how much? 1 year. Here vesting is how much? 2 years. Here vesting is how much? 3 years. So this is what is your vesting under the 3 plans. Options. This is 60 into 20%. That is 12 options. Options कितने होंगे यहाँ पे? 60 into 40%. That is 24 options. And here 60 into 40%, 24 options. So this takes care of our basic plans. Fair value, rupees 10. Fair value 12.5. Fair value 14. So this takes care of the 60 options. We are explaining how the plan moves over how the plans are over the 3-year period. Okay. So now let us proceed to calculate the employee benefit expenses. Calculation of employee benefit expenses. So we will be having, look at the presentation first. Accordingly, you can make the columns. Plan 1, year 1. Plan 2, 2 years. So year 1 and year 2. Plan 3, year 1, year 2, year 3. Okay, so this is how you will be having your presentation. Okay, so particulars. So the first data that is needed is number of employees. Number of employees. This has to be typically end of vesting. End of vesting. So in the first year for plan 1, if you look at the question, 400 employees are covered, out of which 40 left. So how many are left? 400 minus 40, bache kitne? 360. Is this actual or estimates, or this is actual? So 360 will be remaining at the end of year 1. So the first group, entire 360 employees, it has vested. It has vested. So this is going to be 360. How do I get this 360? Well, 400 minus 40. This is actual. This is actual. Okay. All right. For plan 2, at the end of year 1, now this is vesting over a 2-year period. This is vesting over a 2-year period. Okay. So therefore, I had 400 in the beginning. 400 में से 40 तो निकल गए at the end of year 1. So that is 400 minus 40. Minus how many are expected to leave in year 2? That is 36. That is 36. So in the first year, when you are doing the accounting, it will be based on estimates in year 2 and 3. So here this is going to be 400 minus 40. ये तो actually चलेगा at the end of year 1. Minus, or what I can do is, to avoid confusion, this is exactly this 360. Minus, in year 2, you are expecting how many to leave? Sir, I am expecting 36 to leave. I am expecting 36 to leave. So at the end of year 1, you are expecting that 324 employees will be there at the end of year 2 also. So you base your calculations on 324 employees. You base your calculations on 324 employees. Is it okay? Yes. So 360 minus 36. All right. Now in year 2, you actually have the number of people who left. So this is going to be end of year 1, it was 360. And how many left? Well, actual number of employees left is 35. So 360 minus 35, this is going to be 325. This is expected. This is actual. This is actual. Have you understood so far? Have you understood so far? Plan 1 and plan 2 are different in the sense that plan 1, the vesting period is 1 year. Plan 2, the vesting period is 2 years. Okay, so dono ko, both are different in that sense. Okay, have you guys understood plan 2 correctly? Have you understood plan 2 correctly? Anybody has any doubts in plan 2? Bolo. Anybody has any doubts in plan 2? It's essentially calculating number of employees expected to remain at the end of the vesting period. Plan 2's vesting period is 2 years. So in year 1, we have to calculate how many will remain at the end of year 2. So 360 minus 36 in the first year. Okay. All right. Soham is asking plan 2 year 1. Can you explain? Okay. I am just going to remove this. Don't look at plan 1. If you want to understand plan 2, don't look at plan 1. Plan 2, take it as an independent case. Okay. take it as an independent case. Independent case का मतलब क्या है? Just think that you have just this one plan available. Don't look at this. Don't look at this. Now look, it is an option. It is a plan where 24 options are given per employee, and 24 options are given per employee, which will vest at the end of 2 years. So I have to calculate the employee benefit expenses. कैसे calculate करेंगे? Well, I have year 1 and year 2. So year 1 के case में, at the end of year 1, I have to book the EBE. So I have to calculate the number of employees. Number of employees will be based on the estimate of how many employees will be expected to remain in service at the end of year 2, because the vesting period is 2 years. So I am having 400 employees on the grant date. Minus year 1 में ही how many left? Sir, 40 actually left. So 400 में से 40 actually left. And you are estimating that in the second year, another 36 are going to leave. Another 36 are going to leave. So your estimate is in year 1 that at the end of year 2, 324 employees will remain. And therefore, you do the calculation for EBE based on 324 employees. अब बात करते हैं year 2 का. Now year 2 has come. Year 2 will be continuing. At the end of year 2, you will have another figure. That another figure is nothing but the number of employees who actually left. So 400 था. End of year 1, 40 left. End of year 2, 35 left. So now we are having 325 employees actual in whom the shares have vested, in whom the options have vested. Is it okay now? Yes. Now I am just removing this. Okay. वो तो समझाने के लिए काटा था. अभी समझो. I think you should be able to understand. So hum just confirm if you have understood. And now you will help me with plan 3. You will help me with plan 3. Okay. Essentially, it is one option. It is 60 options. It is vesting as 12 options in year 1, 24 options in year 2, 24 options in year 3. Now, you guys will help me for plan 3. Plan 3 क्या है? सोचो. Don't look at plan 2. Don't look at plan 1. भूल जाओ इसको. Don't look at this. Let us look at only plan 3. What is plan 3? Sir, plan 3 is 24 options with a fair value of 14 on the grant date, having a vesting period of 3 years. Okay. So year 1, I start with 360. Sorry, not 360. I start with 400 employees. Okay. Come on, tell me now. What am I going to take? Well, year 1 के end में 40 actually left. Yes, sir. And how many are expected to leave in year 2? Sir, 36 are expected to leave in year 2. But my vesting period is 3 years, na? So I should also have an idea of how many will leave in year 3. So number of employees expected to leave in year 3 is 34. So 400 minus 36 minus 40 minus 36 minus 34. Okay. 400 minus 40 minus 36 minus 34. Manini, आप accountant हो, astrologer नहीं, आप future नहीं देख पाओगे. You can only estimate right now. This fact 35. When are you going to come to know? End of year 2. Sir, right now I am in year 1. Na? So in year 1, I only have one actual. That is year 1 में कितने चले गए. And I am having 2 estimates. How many will go in year 2? How many will leave in year 3? So it is going to be 400 minus 40 actual minus 36 year 2 estimate minus 34 year 3 estimate. Absolutely right. Okay. So I hope you got that, Manini. So 400 minus 40 minus 36 minus 34. So जल्दी से बताओ कितना होता है? Yes. Come on. Tell me. Yes. 400 minus 40 minus 36 minus 34. So you are expecting that 290 employees will remain. 290 employees will remain. Come on, now come to year 2. Year 2 में बताओ भाई कितने employees रहेंगे? Just help me with this. See, year 2, the stock option plan began with 400 employees. Out of 400, 40 left in year 1. Actual, मेरे को मालूम है. I am in year 2. I knew how many left in year 1. So this is not an estimate. End of year 2, what do I know? End of year 2, what do I know? Do I have to estimate the number of employees leaving in year 2? Sir, क्यों करना है estimate? मेरे पास तो actual है ना. What is the actual? Sir, actual employees left is 35. So here I will have minus 35. And plan 3 year 2. I have to estimate the number of employees that will remain at the end of year 3. So year 2 के case में, will I consider 28 or will I consider 30? Will I consider 28 or will I consider 30? जरा सोच के जवाब दो. Okay. Be careful. Your whole, it's English. This is not accounting. Okay. 400 minus. Socho, be careful. Rashmi Kamath, that is right. Okay, Sumit Jain, think. Now I am in year 2. Year 1 तो खत्म हो गया कब का? Now I am in year 2. In year 2, what is my situation? Year 1 began with 400. Out of 400, 40 चले गए. I am actually left with 360 at the end of year 1. Year 2 में 35 चले गए. I am left with 325. The question is, for the third year, what estimate am I going to take? Am I going to take 34? No, 34 is the estimate in year 1's end, which you had made for year 3. अभी तो year 2 आ गया ना, so you would have gotten additional facts. Additional information would come to light. आपको ज्यादा मालूम पड़ा होगा. And end of year 2, you now think that, sir, 34 नहीं जाएंगे. Only 30 are going to go. So 30. So what is going to be left is 295. So minus 30. So this comes to how much? Sir, this comes to 295. And in year 3, संभल के give me the right answer. Year 3 में कोई estimate होगा? Will I have any estimate in year 3? Not at all. This will be 400 minus 40 minus 35 minus actual कितने गए? 28. That is 297. सर ये तो कैलकुलेट करने की जरूरत भी नहीं है, ये तो डायरेक्टली दिया है. एम्प्लॉइज एट द एंड ऑफ लास्ट वेस्टिंग पीरियड. Employees at the end of last vesting period is directly given to you. Okay, so that is your third plan where 40% of the options are vesting after a 3-year period. Okay, have you understood? But this is the only important thing in this question. Okay, if you got this right, it means you will get the question completely right. Okay, you will get the question completely right. All right, so that takes care of the number of employees. बस उसके बाद क्या है? उसके बाद it's typical accounting. It's just typical calculations. Okay, so this is number of employees into number of options. First plan, this is number of options per employee. How many options in the first case? 12. How many options in the second case? 24. Third option, how many? 24, 24, 24 into fair value per option. This is in rupees. This is fair value as on the grant date. First case it was 10, second case it is 12.5, third case it is 14. So what are you going to do? This gives you total EBE. So 360 into 12 into 10. That gives you how much? 360 into 12 into 10. This is in rupees. So this gives you 43,200. Second case, 324 into 24 into 12.5. 97,200. into 24 to 12.5, 97,500. Here 290, 24, 14, 97,440, 295, 24, 14, 99, 120, 297, 24, 14, 99, 792. Okay. So this is the total EBE, and this I will prorata into prorata. This is for 1 year. This is for 2 years. This is for 3 years. So this is going to be EBE till date. 43,200, 48,600. This is 97,500. 32,480. 66,080. And then 99,792. Less earlier recognized. ये तो फर्स्ट ईयर है, नील. सर ये तो सेकेंड ईयर है. नो नो, दिस इज फर्स्ट ईयर ओनली. डोंट डू दिस, गड़बड़ हो जाएगा. ये these are two different plans. Okay. So this is 0 here. This is what is going to come here. 48,600. Don't take 97,500 here. This is plan 3. So therefore here this is going to be nil. This is going to come here. So this comes to how much? 32,480. And this is 66,080. Okay, so that takes care of the expenses for each year. So this gives me EBE for the year, for the current year. 43,200, 48,600, 48,900, 32,480. This is 33,600, and last one is 33,712. 33,712. Okay. So if I look at total EBE expense, total EBE expense. This is going to be year 1, plan 1 43,200, plan 2 48,600, plan 3 32,480. These ones 1, 2, 3. So this is going to be 43,200, 48,600, 32,480. So that comes to 124,280. Year 2. Year 2 कैसा आएगा? It is going to be 48,900, 33,600. Rupees 82,500. Year 3. 33,712. Excellent. Kaushiki has confirmed the figures. Yes, that's right. Okay, so it's all correct. All right. So this is your expenses to be recognized each period. Done. What you have to do is imagine this problem from the perspective of the accountant. Imagine this problem from the perspective of the accountant. You will not go wrong. You will not go wrong. You will just be fine. Okay. So that takes care of the expenses. Aja, they have told to prepare important ledger accounts. So your important ledger accounts will be employees compensation expense or employee benefit expense account. That is the first account. Simple. Employee benefit expense to share based payment reserve and credit will be by P&L. तो ये 3 साल होगा 124,280, 82,500 and 33,712. I'll not sit drawing that account. What I want to show you guys is SBP reserve account. Okay, because there is a little bit of, I won't say complication, but it's just that it should come in place. Okay, SBP reserve. Okay, yes. All right, so year 1. Year 1. By employee benefit expense. What is the expense at the end of year 1? Can somebody tell me? 124,280. So 1,24,280. Now, at the end of year 1, what happens? Sir, क्या होना है? Sir, this plan vests and gets exercised. And those who don't exercise, it will lapse. Those who do not exercise immediately, it will lapse. So therefore, I have to give the effect to this. Na? End of year 1, it has vested, exercised and lapsed. All the 3 are happening. So let us look at the case of the first plan. Let us look at the case of the first plan. Okay. What I'll do is, I'll write the journal entries here. Okay. So then you will not be confused. Okay. This should be fine, I think. No, I think I'll write on a different page. Okay. Year 1. Exercise. Okay. So now, when the options get exercised, what is the entry we pass? Well, the entry will be bank account debit, SBP reserve debit to share capital to securities premium. Okay, so this is what we pass. Now you will help me with the figures. How many employees have exercised the options? Sir, 350 have exercised the options. Okay, so this is going to be 350 employees into 12 options into, they will be paying the exercise price of 125 into rupees 125. So 350 into 12 into 125. So this gives you 5,25,000. What will be the number of shares? 350 employees into 12 options. Shares will be credited with 100 rupees. So 350 into 12 into 100. 4,20,000. 4,20,000. Are you able to follow? Are you able to follow? Yes. Are you able to follow this? Yes. Have you followed this part? Okay, all right, good. So now coming to securities premium and SBP reserve. How am I going to calculate? Simple, please pay attention. The fair value of the option, is how much? Sir, it is rupees 10. It is rupees 10. So this is essentially the SBP reserve component. This is essentially the SBP reserve component. If you look at my SBP reserve calculation, which is there in EBE, I am ultimately multiplying it by 10. I am ultimately multiplying it by 10. So this 10 is what has gone and sat in your SBP reserve. Now 350 employees have exercised. So this 10 is going to be utilized for that. Okay. So let us start with that. 350 employees into 12 options into rupees 10. 350 into 12. So this comes to 42,000. And what is your securities premium? You can take it as a balancing figure. No problem. Sir, हमको confirmation चाहिए, balancing figure नहीं. 125 is what the employee has paid. 10 rupees is what is the SBP reserve per share. Okay, 10 rupees fair value. So total fair value is 135. Out of that, 100 has gone in your equity capital. So 35 is remaining for securities premium. 350 employees into 120 into 12 options into rupees 35. So 350 into 12 into 35, that gives you 1,47,000. Excellent. Manini has confirmed Soham's calculation is right. Have you guys understood? Have you guys understood? Yes. Acha, we started off with 400. छोड़ के गए 40, बचे 360. 360 में से 350 exercised, so lapsed is 10. Lapsed is 10. Okay. So this is exercise. Then we look at the lapse. Lapse के case में the entry is going to be SBP reserve debit to retained earnings. To retained earnings. SBP reserve to retained earnings. How do I account this? Well, 360 minus 350 employees into 12 options into rupees 10 into rupees 10. इन्होंने एक्सरसाइज नहीं किए, और नहीं किए यानी चले गए. 1200. Yes. So that takes care of year one. Let us post these entries in the ledger. So by bank, 5,25,000. To equity share capital, 4,20,000. To securities premium, 1,47,000. Retained earnings, 1,200. Total this up, 649,280. You will get a balancing figure, 81,080. To balance carried down. Please explain securities premium. Why it is 35 and not 25? Okay. Understand. Employee. What is he giving? Sir, he is paying 125. Easy paying only 125. जरा सोचो, easy paying only 125. No. उसको एक साल मेहनत करनी है. He has to work for 1 year. तब जाके उसको ये शेयर 125 में मिलेगा. सर वो मेहनत का वैल्यू कितना है? फेयर वैल्यू ऑफ ऑप्शन ऑन द ग्रांट डेट. फेयर वैल्यू ऑफ ऑप्शन ऑन ग्रांट डेट कितना है? सर इट इज 10. So therefore employee कितना दे रहा है? Employee is giving 125 in the form of cash and 10 in the form of service. So total employee कितना दे रहा है? 135. Against 135 मेरा face value कितना है? 100. That is why 35 is your securities premium, not 25. Okay. यार वो 125 तभी मिलेगा ना उसको if he works for 1 year. वो एक साल के मेहनत का वैल्यू 10 रुपया है. Okay. That 1 year's hard work is worth 10 rupees. Okay. So that takes care of all the doubts. Okay, excellent. So we then move on to the next part. Group 2 exercising options is 319. No problem. You will now help me with the entries, guys. You will now help me with the entries. हमको लग रहा है बहुत टाइम लिया हमने, but I hope that you are able to understand. Okay. अच्छा, brought forward नहीं लिखा. By balance brought forward 81,080. 81,080. Okay, so now let us again proceed to calculate. 319 are exercising. So exercise. Bank account debit, SBP reserve debit to equity share capital to सिक्योरिटीज प्रीमियम। अभी फटाफट बोलने का, ओके, चुपचाप बैठने का नहीं। बैंक अकाउंट हाउ मेनी 319 एम्प्लॉइज इनटू, बोलो व्हाट इज द नंबर ऑफ ऑप्शंस पर एम्प्लॉय? नंबर ऑफ ऑप्शंस 24 ऑप्शंस इनटू what is the exercise price? What is the exercise price? Sir, exercise price is 125. So 319 into 24 into 125, 9,57,000. SBP reserve 319 employees into 24 options. 2 साल के मेहनत का वैल्यू कितना है? 12.5. 12.5. So 319 into 24, 12.5, 95,700. अरे yes or no? Yes. Manini, yes. Three 319 employees, 24 options into rupees 100. 319, 24, 100. 765, 600. To securities premium. Yes. What will be my securities premium? 37.5. So 319 287 100. 287 100. Okay, great. बस तो फिर अच्छा lapse. Sir, how many are getting lapsed? Sir, totally at the end of 2 years, look at your workings. Look at your workings. कितने एम्प्लॉइज बचते हैं? 325. आपने कितना पकड़ा है? 319 have exercised. So balance 6 employees are getting lapsed. 6 employees are getting lapsed. Okay. $325 minus 319 employees into 24 options into rupees 12.5. So basically that ends up with 1,800. 1,800. Okay, so let us give the effects by bank. 9,57,000 to equity share capital 7,65,600. Securities premium 2,87,100 to retained earnings. Don't forget this. Okay, many students forget the lapsing. Don't forget 1,800. What is the balance carried forward? अच्छा, compensation expense account ही नहीं किया. एम्प्लॉय बेनिफिट एक्सपेंस कितना है भाई 82,500. Yes, now you should to balance carried down. $1120,580. 1120,580. By balance brought down 66,080. Is everyone with me at the end of 2 years? Is everyone with me at the end of 2 years? This is a classic question. Okay, mark this as important. This is a classic question because at the end, it contains everything relating to employee stock options. Basically, it is 1 plus 2 plus 3. It is 6 problems combined into one. And it is covering the calculation of EBE also. It is covering the ledger accounts also. It is covering the vesting period as well as the exercise period. So this is a very beautiful question. Exam se ek din pehle you revise this and go for your ESOPs. Don't do anything else. Okay. Because isme sab aa jata hai. Okay. All right. Aniket Jain, Manini, Rakesh, Rashmi. So hum done. All right, Kaushiki done. Srishti Goyal is not there today. Hari, Gauri Shankar Rao, are we all together? Sumit Jain, Aniket Jain, all confirmed? Yes. Okay. So let us proceed further. Okay, there is a new student, Nidhi Deshpande. Okay, fine. Good. All right, so that takes care of year 2. Let us move on to year 3. Acha. Before we complete year 3, let me tell you, at the end of year 3, are all the plans expiring? Yes. So technically your SBP reserve balance should be 0. That means end of year 3, the check is what? SBP reserve should tally. There should not be any carry forward figure. Okay. If that is right, if that is the case, your answer is right. If that is not coming, then your answer goes something wrong. Okay. Something wrong would have been done. Okay. So dekhte hain. Let us have a look. Exercise. Bank account debit. How many are exercising? Employees exercising is 295. Employees at the end of the period is 297. That means 2 are not exercising. Okay. So bank account debit. $295 employees into 24 options into rupees 125. 295 into 24 into 125. 8,85,000. 8,85,000. Then I'm having SBP reserve. 295 employees into 24 options. उसके मेहनत का क्या कीमत वसूल रहे हम? What is the fair value? 14 into rupees 14 debit. 295 into 24 into 14. 99,120. Acha. Next. Next. 2 equity share capital. 295 employees into 24 options into rupees 100. 295, 24, 100. So 7,08,000. 2. Securities premium. Securities premium. 295 employees into 24 into rupees. कितना रहेगा भाई securities premium? 125 plus 14 minus 100. 39 into 24 into 295. 2,76,120. And then finally we are having what? Finally we are having the lapse of 2 employees. 297 were there, 295 only exercised. So therefore the lapse is going to be for 2 employees. Okay, so lapse, I'm just fitting it in here. SBP reserve debit to retained earnings. $297 minus 295 into 24 options into 14. So that comes to 2 into 24, 48 into 14, 672. 672. And now we do the posting. By bank, 8,85,000. By employee benefit expense, last year it is 33,712. 2. Equity share capital. This is going to be 7,08,000. 2. Securities premium, 276,120 to retained earnings, 672. And now the account should tally. Now the account should ideally tally. Are we okay at this stage? Bolo. Are we okay at this stage, or we still have any doubts? Yes, sir. Rashmi has confirmed. Aniket has confirmed. Nidhi Deshpande, Soham, Sumit Jain, Aniket Jain, Gauri Shankar Rao, Kaushiki. Where are you guys? Okay, Rakesh has also confirmed. What about forfeiture? हो गया ना? कितना forfeiture करोगे? This is a forfeiture. This is a forfeiture. This is a forfeiture. अब और कितना चाहिए forfeiture? Yes, all these forfeiture is basically what are getting lapsed. So the last one is for 2 employees. The second year is for 6 employees. The first year is for, I think, 10 employees. Okay, so forfeitures are also recorded. Everywhere I have written also, I think. lapse, lapse, lapse. Okay, so that is also written. So all right, excellent. So that takes care of graded vesting. We quickly come to the initial part of your, if you have left the 4-5 pages there, we'll just write a small paragraph for graded vesting, so you can just have an idea. Okay, so you can give the heading graded vesting in your theory and write down, in this case, comma, options vest in a phased manner. In a phased manner. The single ESOP plan is segregated into separate plans based on vesting period and the accounting would be done independently, as if they were separate plans. As if they were separate plans. Okay, so that is how you are going to account for. As if they were separate plans. Okay, so anybody has any doubts until here? Any doubts until here? No doubts, तो आगे बढ़ते हैं. Let us proceed further. Let us proceed further. Okay. Acha, done. Okay, fine. So now coming to the next part, that is, sir, we have now discussed vesting, exercise, graded, and indirectly we have also discussed one vesting condition, that is vesting condition which is a service condition. Whatever questions we have done so far, we have always had vesting period for 2 years, 3 years, SA. So that means it is to be presumed that the employee has to remain in service. It means it's given in the question, not presumed. The employee has to remain in service for a particular number of years before he can actually get entitled to exercise. So this is known as vesting conditions. What do you mean by vesting conditions? These are the conditions that need to be fulfilled by the employees in order to get entitled to exercise the options. Okay, so vesting conditions can typically be divided into two types. One is service condition, the other is a performance condition. Service condition मतलब कुछ नहीं, आने का रहने का एम्प्लॉय बन के वो 2 साल 3 साल के लिए और फिर एक्सरसाइज हो जाएगा. No performance related requirements. आके वो let him warm the seat also, that is fine. He will get the options at the end of the vesting period. So that is known as a service condition. He has to remain in service. However, there are also performance related conditions. There are also performance related conditions which can be segregated again into two types. One is a non-market related condition. Non-market related means if you are joining in as a cost controller in your organization, you will be given the target to reduce the costs of manufacturing by say 5% at the end of 3 years. If you achieve the 5% target at the end of 3 years, options vest in you. If you are not able to achieve, options will not vest in you. Acha. Can it only be this? No, you can give the sales director a sales target, achieve volumes of 1 lakh units at the end of 2 years, and then the options will vest in you. So this is a non-market linked condition. It is a performance linked condition. You can also get a condition like the earnings per share should be so much for the finance department. So the finance department will then bracket set on how to get that earnings per share. And accordingly, if the EPS reaches a particular figures, the options will vest in the finance department. ऐसे बहुत सारे indicators हो सकते हैं. Okay, these are just some sample indicators which I have given to you. So these are my non-market linked performance conditions. अच्छा, इसका importance क्या है? You have to look at each vesting period, at the end of each year in the vesting period, whether the condition will be fulfilled or not, and at what point of time. And accordingly, you will modify the estimate and carry it forward. You will modify the estimate and do the accounting in the subsequent periods. So suppose you are given a target of say 20% increase in sales volumes by the end of third year. By the end of third year. End of year 1, if you feel you will cross that 20%, fine, you can tell that it is exceeding and therefore you are going to record it as 1/3. Year 2, you think it may not exceed. So whatever you have recognized, you can reverse it. Year 3, you get the actual data. So that is how the accounting progresses. Sir, ye to ho gaya non-market linked performance condition. Acha, market linked performance condition. Well, that will be something like if the price of the entity's share increases by 20%, or the second case is if the Nifty rises by so much, or the third case is if the Sensex falls by so much. Whatever be the case, this is market linked performance condition. Achha. Market linked performance condition. Market linked performance condition का मतलब क्या होता है? It means that you are now shifting the onus from something which the company can control to something which the company cannot control, to something which the company cannot control. By market, so market will decide all these facts. So the question is, should we consider the likelihood of the estimation, the likelihood of the chance that the market linked condition will be fulfilled or not? Standard says wait. We are recording the option at the fair value as on the grant date. Hanji bilkul. So if we are calculating the option at the fair value on the grant date, fair value is nothing but a forward looking value for the entire vesting period. So when I look at the forward looking value for the entire vesting period, I would have factored into the accounting all the conditions that would likely arise. Okay, so when you look at share pricing models in your SFM paper, you would already see this. It factors a lot of things like beta and risk-free premium. All these things go together in calculating your what you can say the market linked performance conditions. So when you are already considering this, this would be a part of the fair valuation done as at the grant date. Future conditions हमने already अभी पकड़ रखा है when I'm doing the fair valuation of the option, and therefore any change in those conditions in the future would ideally change the fair value of the option. Answer is yes, वो तो होगा ही. The question is, am I permitted to change the fair value of the option? Answer is no, you are not. So if you are not permitted to change the fair value, can I therefore give effect of the change in the market conditions? Answer is no, you cannot. Because of two arguments. Because of two arguments. So देखो जरा ध्यान से सुनो. We'll write this down, but first understand the reason why we do not give effect to market linked conditions. First one is ESOPs are valued at fair value as on grant date. अच्छा, fair value is a future looking value based on option pricing model like Black-Scholes, etc. Okay. Now, suppose the vesting horizon is 3 years. Suppose the vesting horizon is 3 years. Vesting period is 3 years. Now, suppose the vesting period is 3 years. Sir, ये 3 साल में तो market कैसे भी move हो सकता है. Nifty can rise, Nifty can fall, Nifty can remain flat. Anything and everything can happen. My market cap may rise, market cap may fall, market cap may not show any change. All those things would be estimated as on the grant date. Grant date के दिन जब हम fair valuation करते हैं, we would have factored all these things. We would have factored all these things. And therefore, in future, in these 3 years, if any of the metric changes, if any of the things have changed, then ideally, this fair value also should be changing. But did these facts exist on the grant date? Answer is no, they did not. That means it can only be estimated one thing, that they would already be factored in the fair valuation. They would already be factored in the fair valuation. And therefore, we do not need to do anything when you are given a market linked performance condition. Sir, कंडीशन चेंज हो गया तो फेयर वैल्यू चेंज हो गया होगा, बट आर यू परमिटेड टू डू द अकाउंटिंग? You do not know that you have to do the accounting, and therefore we are not going to give any effect for market linked performance condition. Market linked performance condition, no effect or estimate. That is, estimate on grant date prevails. Estimate on grant date prevails. Estimate on grant date prevails. Is it okay? So this is as far as market linked performance conditions are there. Don't give any effect to the future, because your fair value on the grant date has seen the future and done it, and thereafter we cannot modify the fair value. So this is the reasoning behind market linked performance condition. What about non-market linked? Soham has asked a question. In performance based, we do not know in which year the performance based condition is going to be met. Then at which fair value to be recognized and how to recognize yearly. At the end of each vesting period, you will have to estimate. आप अंदाजा लगाओ, estimate करो, सोचो, prediction करो कि ये condition कब fulfill होगा. When you give an option with a performance condition, you are in effect motivating the employees, यार option ले लो, option के लिए ये condition fulfill करो. So indirectly, you know that your employees will be in a position to meet that condition thereafter. However, suppose they are unable to meet, you estimated they would meet, but they are unable to meet, तो जो recognize किया है उसको reverse कर दो. There is no other option there. It is an estimate. Okay, estimates can change in the future. Okay, estimates can change in the future. All right, so that is how the accounting will happen. We have to estimate. We have to estimate and do the accounting accordingly. Okay. All right. Are we okay with the theory on vesting conditions? Yes. These are conditions which the employee has to fulfill. It could either be a service condition or a performance condition. Performance के case में you would have market linked or non-market linked condition. Market linked, ignore. It is already included in fair value as at the grant date. Non-market linked, you will have to take into consideration at the end of each vesting period and determine what is going to be the what you can say, what is going to be the employee benefit expenses. Okay, so that takes care of vesting condition. Thoda bahut examples dekhenge, you will be in a position to understand better. Okay, you will be in a position to understand better. All right, so let us come to this question. Okay, let us start to solve. ACC Limited granted 10,000 share options to one of its managers. Okay. In order to get the options, the manager has to work for next 3 years in the organization and reduce the cost of production by 10% over the next 3 years. That means, is it a performance condition? Yes. Is it a market linked performance condition? No, it is a non-market linked. So will you consider this in your estimate every year on year? Answer is yes. Fair value of option as at the grant date was rupees 95. So cost reduction achieved in year 1 is 12%. You are expecting it to be achieved at the end of 3 years. Year 2, it is 8%. And when it is 8%, you will expect not to vest in the future. So whatever you have calculated, you will reverse that. Year 3, it is actually getting achieved. So therefore, whatever you will reverse, you will then automatically bring it back again. So how would the expenses be recorded? How would these expenses be recorded? So what is this? This is a service condition with a performance condition. Which performance condition? Non-market link. Do I have to consider that? Yes, you have to consider that. Okay, so let us then look at the workings. Let us then look at the workings. Okay. Calculation of employee benefit expense. Particulars. Year 1, 2, 3. Number of employees 1, 1, 1 into options per employee. 10,000. I'm just writing the data. I am not yet gone into the estimations. Okay. Into options into fair value. What is the fair value? 95. Okay. So this is what is there. Now at the end of each vesting period, you will ultimately see whether the option vests or not, and then proceed to calculate the EBE. Okay. So this gives you total EBE into pro rata. This gives you EBE till date less EBE recognized earlier. So that gives you EBE current year. Okay. So now let us look at the question. Year 1, he has achieved a 12% target. So then he estimates that at the end of 10 years, at the end of 3 years, he would achieve the reduction of 10%. So will he meet the condition? Answer is yes. So this comes to 9,50,000. He will meet the condition after 1 year. So 1/3. So this comes to how much? This comes to 3,16,667. 3,16,667. Less employee benefit expenses recognized earlier. Nothing. This is the first year. So 3,16,667. ये तो हो गया year 1. Year 2 has been a very bad year. Year 2 has been a very bad year. So therefore, cost reduction achieved is only 8%. Is only 8%. Okay. The organization had reduced the cost of production by 10% over the next 3 years. Okay. So this is what you are going to do. You are now not expecting this to vest. You are now not expecting this to vest. And because it is not expecting to be vested, can you recognize the what you can say? Because it is expected not to be vested, can you reverse the expenses already recognized? Definitely you can. So therefore, this is going to be 0. This is going to be 0. And then this is 0. Pro rata not applicable. EBE till date is going to be nil. Yes, EBE recognized earlier 3,16,657. 3,16,667. So EBE for the current year is actually going to be a negative figure. Is actually going to be a negative figure. Kyun aisa? Because now I thought I'm not going to meet that condition, and therefore reverse that 3,16,000 which you have already recognized. And now in the third year, you expect to achieve the target. So 95 into 1 into 10,000. So this comes to 9,50,000. Yes. Next one is pro rata 3/3. 9,50,000, but EB recognized earlier is only nil. So 9,50,000. 9,50,000 is the EBE for the current year that you are going to record. So first year 3,16,000, second year reverse the first year, and third year again book the entire expense. Is it okay? Is it okay? Done? Have you guys understood? Kaushiki has confirmed. Manini has confirmed. What about the boys? Done? Okay. So that takes care of non-market linked performance conditions. Non-market linked. Every year you estimate and do the accounting accordingly. Okay. So that takes care. We take a 5-minute break, and we shall continue after 5 minutes. Class will go on till say about 10:30. Okay, because I still have to do market link performance conditions, modifications in options, cancellation, group based options, and equity options with a cash alternative. So these are the 4-5 topics still left. So we'll be doing that. So I will therefore be extending the class by about half an hour. Okay. If there is any doubt, please punch in, and see you guys after 5 minutes. Okay. Okay, all right. So welcome back, guys. So we discussed this last question. So I'll just quickly plot the journal entry for us. Year 1, the entry will be EBE account debit to SBP reserve. This is an option, right? Yes. So 3,16,667. Year 2, I do not expect the cost targets to be achieved. So I will reverse whatever is accounted. So SBP reserve debit to EBE 3,16,667. Ultimately, this flows to the P&L. This flows to the P&L. And finally, in year 3, EBE debit to SBP reserve 9,50,000. Okay, so this is what will be the entry. So what I want you to appreciate is the fact that just by a mere estimate, I have been able to reduce my P&L expenses by 3,16,000. So there is a huge amount of manipulating the profit figures in these kind of chapters. So chapters like stock options, chapters like where there is a lot of estimate based accounting, there is obviously going to be a huge scope to manipulate the profit. Okay. Because of your estimate in the second year, probably it was a bad year. So you thought, why not we manipulate the figures and estimate बनाएंगे तो कि वो खत्म नहीं होगा, cost targets match नहीं होंगे, next year का next year देखेंगे. So you have reduced the expenses, increased the profits. So there is a chance that profit can be manipulated. That's right, Soham. Okay, so that takes care of the service condition, which is a non-market linked, sorry, not performance condition, which is a non-market linked performance condition. Okay, so you are having a reduction. You are having a reduction. However, be careful that do not plot this reduction to the retained earnings. Okay, because lapse nahi ho raha hai. Options are very much alive. It's just that you believe they do not vest. Okay, options are very much alive. 3 साल का option tenure है. So therefore, at the end of 2 years, options अभी भी जिंदा है. So don't take it to retained earnings. You will take it to P&L. Okay. Because ultimately you will ask the question, SBB reserves, why are we taking it back to P&L when in the previous case we had taken it to retained earnings? This is different, that is different. Those are lapsed. This is reversal of an estimate. Okay, so they are two different things entirely. All right, so that takes care of this part. Okay, now we come on to the market linked performance conditions. Now we come on to the market linked performance condition. Okay, let us look at the next question. Question number 6, slide 16, illustration 9. Apple Limited has granted 10,000 share options to one of its directors, for which he must work for the next 3 years. The price of the share should increase by 20% over the next 3 years. The share price has moved as per the below details. 22% year 1, 19% year 2, year 3, 25%. At the grant date, the fair value of the option is 120 rupees. How should we recognize the transaction? Very simple. Is it a performance condition? Yes. Is it market linked? Yes. Ignore. That means what? What the standard believes is this price movement, would have been estimated in the fair value. And therefore, there is no need for us to again give effect for the changes. That is one way of looking. Or the other way of looking at it is, bhai, already the fair value is determined. Now you cannot change the fair values. You cannot change the fair values, and therefore there won't be any impact of this share price movement. Okay, so if I have to present the answer, this is your illustration. क्या है? 9. Illustration 9. It is going to be a very simple answer. The performance condition is market linked and hence possibility of vesting, non-vesting should not be reassessed each year. It is already done in the fair value computation. It is already done in the fair value computation. So, calculation of employee benefit expense. Calculation of employee benefit expense goes something like this. Year 1, 2, 3. Number of employees. यार एक ही वो मैनेजर या डायरेक्टर क्या है वो डायरेक्टर. So 1 multiplied by options per employee. So this is 10,000. This remains 10,000. It has gone below 10,000, but no, we will not consider that. Into fair value. Rupees 120, 120, 120. So this comes to total EBE in rupees 12 lakhs. Many students go wrong in the second year. They see that there is only a 19% increase and they say it is not vested. वो गलत है. Okay. Total EBE pro rata 1/3, 3/3, 2/3. So this comes to 8 lakhs, 4 lakhs of the first year. So 4 lakhs. Let us then proceed to fill this EBE till date. Rupees 4 lakhs plus EBE earlier recognized rupees. So 4 lakhs, 8 lakhs, 12 lakhs minus 8 lakhs. 4 lakhs, 4 lakhs. EBE for current year in rupees. Is it okay? Have you guys understood? Yes. Any doubt so far? Any doubts? All clear? All clear? Yes, so Manini has confirmed. So let us move on to the next part. This illustration is solved. Okay. Now we move on to the next part. Okay. An entity issues share-based payment plans to its employees based on the below details. Number of employees is 100. Fair value at the grant date is 25. Market condition share price to reach 30. So this is to be ignored. Service condition, to remain in service until market condition is fulfilled. Expected completion of market condition is 4 years. Define expenses related to such share-based payment plan in each year subject to the below condition. That is market condition if fulfilled in year 3 or the market condition is fulfilled in year 5. If nahi hoga, is hoga. Market condition is fulfilled. Okay. Now, look at the way the question is. Look at the way the plan is. You are having a performance condition. Okay. That performance condition is a market linked performance condition. Okay. So that will be ignored. That means we will not consider whether the price reaches 30 or not. That is irrelevant to us. But look at the service condition. Service condition means he has to remain in employment until the market condition is fulfilled. Agreed. So I have to estimate when the market condition will be fulfilled. I have to estimate that. Okay. Now, if I estimate that period on the grant date, what I estimate will be my initial basis for measurement. Will be my initial basis for measurement. Okay. सर अभी तो आप कह रहे थे आप नहीं लोगे, अभी आप ले रहे हो. लेना पड़ेगा because I have to determine the estimate when the market price will touch 30 rupees, because that time period is deciding my vesting period, and vesting period is a service condition, and service condition means मेरा EBE कितना रहेगा, I have to find that out. And therefore the standard tells us that you will determine the vesting period on the grant date. Okay. Now, in the future, if the market condition of 30 rupees share price is met beyond year 4, हम उसको ignore करेंगे, because on the grant date I thought it will be met in 4 years. Basis that I have determined the fair value on the grant date. So therefore, if the market price touches 30 in year 5, 6, kabhi bhi, I will still record my EBE over a 4-year period. Sir, 2 साल में touch हो गया, 3 साल में touch हो गया. If you meet the condition within 2-3 years, then the shorter period will be your EBE expense recognition period. So suppose you meet it in year 3. Year 1, you will do the apportionment on 1/4. Year 2, you will do the apportionment on 2/4. Year 3, you met the condition. Whatever is the balance, write it off entirely, which is what we are going to do. Okay. So let us proceed to do this question. Then we shall write theory. So then we would be done with market linked and non-market linked performance condition. Okay. So this is, I think, illustration question 5 of test your knowledge. Okay. It's a very logical understanding. So let us proceed to do this. Okay. So this is part A. Actual vesting happens in 3 years. This fact comes to your knowledge only in the 3rd year. मेरे को फर्स्ट एंड सेकेंड ईयर में आई विल नॉट बी नोइंग इट. सो फर्स्ट ईयर सेकेंड ईयर आई विल डू द अपॉर्शनमेंट बेस्ड ऑन 4 years. थर्ड ईयर में आई मेट द कंडीशन, सो ऑप्शंस वुड बी वेस्टिंग, एंड देयरफॉर वी विल डू द एंटायर राइट ऑफ इन द थर्ड ईयर. ओके. सो आई एम हैविंग year 1, year 2, year 3. Okay. Year 1, 2 and 3. So now, number of employees is how much? 100 into options per employee. How many options? Issues share-based payment plan. They have not given the options number, so 1 ही ले लेंगे. 1 into fair value per option. The fair value is how much? 25. Acha, in this fair value, I would have included the estimate of 4 years already. I would have included the estimate of 4 years already. Okay. So this gives me total EBE 2500 multiplied by pro rata. First year, I think I'll meet it in 4 years, so 1/4. Second year, I think I'll meet it in 4 years, so 2/4. Third year, I met it completely, so into 3/3. And then you do the calculations accordingly. So this comes to EBE till date 625 1250 2500 less earlier recognized nothing 625 1250. So EBE current year EBE 625 entire thing I wrote off in the third year because actual vesting would happen in the third year. So therefore you will do the accounting in this way if the actual vesting period is 3 years. Are you clear about this? Are you clear about this? Yes, Vishal, Nidhi Deshpande, Soham, Rakesh, Aniket Jain, Kaushiki, Manini, Srishti is not there today. Rashmi Kamath, Gauri Shankar Rao. Are we all clear with this? Yes. Aniket Jain confirmed, Kaushiki confirmed, Manini and Rakesh. These three guys have confirmed. Okay. All right. So we then move on to the next part, 5B. Actual vesting is 5 years. Acha, when it is 5 years, can you extend your horizon till 5 years? Answer is no, that you cannot do. Because initially when you determined the fair value, you thought you would achieve the fair value target in 4 years, basis which your value is determined. And therefore the vesting will happen at the end of 4 years, even though the target has not met, because the target is a market linked performance condition which has to always be ignored. Okay, so year 1, year 2, year 3, year 4. So number of employees. Okay, so I start with total EBE. Okay, वो तो same रहेगा 2500. I'm saving on time. Into pro rata. The condition is met in the 5th year. In spite of that, we are apportioning over 4 years because that is what we estimated on the grant date, which estimate has gone in the fair value as on the grant date calculation. So therefore we will be doing it based on 4 years and not 5 years. Okay. Sir, previous case में 3 क्यों लिया? हाँ, because 3 साल में actually it's vesting. Actually it's vesting. 4th year में if employee comes and tells give me the share, you have to give him because the shares are already vested in him. But 4th year mein, in this case, the vesting happens in the 5th year. He will come in the 5th year. But for you, your estimate has already happened based on the 4-year prediction you made at the time of assessing the fair value. And therefore, we will do the apportionment over a 4-year period. Okay. Okay, so this is done. आई बात समझ में? Have you understood now? Yes. Okay. Shares will not be allotted at the end of 4 years. Soham. Shares will be allotted at the end of 5th year only. Shares will be allotted only when the market condition is fulfilled. But you have recorded the fair value. You have computed this fair value of 25 based on a 4-year estimate. This estimate won't change if the time horizon crosses 4 years. ये estimate change नहीं होगा. हाँ, exercising will happen thereafter. Exercising will happen thereafter. 5वें साल के बाद ही exercise होगा. But EBE जो है, that will be over 4 years only, not beyond 4 years. Okay. Did you follow, Soham? Yes. So EBE for the current year is this. Okay. So that takes care of the question. All right. So now we write quickly some theory for this. We quickly write some theory, give the heading, come to the theory section. We left about 4 or 5 pages. Give the heading, vesting conditions. Vesting conditions. Okay. These are conditions which need to be fulfilled by employees to get entitled to the shares or options or SARs. Okay. Since the market condition not fulfilled, then any need to fulfill the commitments you will have to fulfill when the market condition gets satisfied. Okay. And that fellow has to remain in service. Okay. So that is the service condition. Okay. No change in that. Okay. So vesting conditions. We can broadly divide them into 2 parts. The first one is service condition. Employee has to remain in service for specified duration. The next one is what? Performance conditions. Employee or entity has to achieve certain targets. Okay. So this is again of 2 types. First one is market linked. Second one is non-market linked. Market linked means the targets are linked to achieving a specific market indicator. Example, share price or market cap or Nifty movement. Nifty movement, etc. Okay. In this case, targets are linked to factors other than market price of entity. Example, sales, cost reduction, etc. Okay, so this is what is the meaning of vesting conditions. Okay. When I talk about market, non-market linked conditions, at the end of each year, estimate whether vesting would happen, which is what we did for that share price, which is what we did for that cost reduction example. 3,16,000 first year, then we thought we would not meet, so 0, and then became 9,50,000. So estimate whether vesting would happen. If yes, when it would happen. When it would happen. And accordingly compute EBE. Accordingly compute EBE. Okay. Whereas in the case of market linked performance condition, do not estimate likelihood of meeting market linked condition as the same is factored in fair value as at grant date. The same is factored in fair value as at grant date. Is it okay? Are you able to understand? Yes, हमने यही किया है, हम यही करेंगे. Okay, and it is perfectly making sense also. Yes, have you guys noted down? Am I going too slow, or I just have given you pointers to write so that you can quickly revise them? Okay, Aniket Jain has confirmed. Is it okay? Yes. All right, done. Nidhi is confirmed. Manini has confirmed. Okay, so I'll just proceed. So, 3 things. Changes in estimated vesting, comma, period, and possibility of vesting. These three things, now you tell me. Non-market linked. Should you consider them? Answer is obviously, we saw that in 3,16,000 minus 3,16,000 and then 9,50,000. So changes to be considered at end of each reporting period. At end of each reporting period. Okay. So this is, you can refer that 3,16,000 wala question, which is कौन सा question था वो? Illustration 8. Illustration 8. Market linked changes to be ignored before actual vesting. I think we had done this in illustration 9, I think. Yes, illustration 9. Illustration 9. Okay. Okay, so that takes care of this part. And then finally, actual vesting. This was question 5. Test your knowledge. Okay. Actual vesting period shorter than estimated vesting period. What did we do? We spread the EBE over the original estimated period initially, and when we came to know it would be met over a shorter period, entire expenditure was written off. So spread EBE initially over estimated vesting period. 4 साल में हमने स्प्रेड किया था बिफोर ईयर ऑफ एक्चुअल vesting. In last year, that is actual vesting, comma, write off entire remaining EBE, which is what we did in that question. Okay. Actual vesting period. This is shorter actual vesting period longer than estimated vesting period. Estimated vesting period. 5 years it was. So what did we do? We did the EBE apportionment over the 4-year period. Spread EBE over estimated period determined on the grant date. That's it. That concludes all your theory on performance conditions. Okay. That concludes all your theory on performance condition. Any doubts so far? Any doubts? Vishal, Manini, Soham, Sumit, Nidhi, Rakesh, Aniket Jain, Kaushiki. Gauri Shankar Rao. Is it clear now? All okay, crystal clear. Okay, great. So that takes care of this part. Now we move on to the next set of concepts. We then move on to the next part. Danny, what all keeps happening here? Sometimes I don't need this. कुछ भी होता है. Okay. All right. We now come to the next important concept. That is, two important things are done. Then repricing is left and cancellation. So that is very simple. Okay. So now we move on to the next part, which is group share-based payment plans. Group share-based payments. Okay. Let us understand this with the help of an example. Okay. Let us understand this with the help of two examples. Okay. Okay. कौन सा example ले ले? I don't want to take the same example as last time, but there is no other way because I have to. Okay. Tata Sons has a subsidiary, Tata Motors. This is case one. Case one. Okay. Tata Sons has a subsidiary, Tata Motors. This is parent and this is subsidiary. Okay. Tata Sons has its employees. It wants to give its employees a stock option plan. It wants to give its employees a stock option plan. Employees bolenge to Tata Sons management, kya faida? You give me your shares. What am I going to do with those shares? Those shares, for all that they may be worth, I cannot sell them in the market. I cannot sell them in the market. And because I cannot sell them in the market, मैं वो share लेके करूँगा क्या? है तो very valuable. It is very valuable, no doubt. But at the end of the day, for the employees, liquidity matters. And I am unable to liquidate these shares. So therefore, what do we do? So what Tata Sons tell is, I understand your problem. I am giving you ESOPs. But in exchange for your service, my subsidiary Tata Motors, which is performing well, is going to issue the shares. So what is happening now? Employees are of Tata Sons and shares are going off Tata Motors. So if I have to look in Tata Sons books and if I have to look at Tata Motors, Tata Sons and Tata Motors, employee kahan kaam kar rahe hain? Employees are working in Tata Sons. So employee benefit expenses debit. ये तो यहां पे डेबिट होगा because employees have served Tata Sons. But can I credit SBP reserve here? Can I credit SBP reserve here? Am I the one who is issuing the shares? Am I the one who is issuing the shares? Yes. What do you think? Are you the one issuing the shares? Can Tata Sons credit SBP reserve? Answer is no, it cannot, because it is not issuing the shares. Can Tata Motors credit SBP reserve? Definitely. वो करेगा भी, because it is the one who is ultimately going to issue the shares. But can Tata Motors debit employee benefit expenses? Answer is no, because technically speaking, the employees have not worked for Tata Motors at all. तो एक परिवार में service is provided somewhere else, reward is coming from somewhere else. Service is provided somewhere, reward is coming somewhere. So therefore, reward is credited in Tata Motors because Tata Motors is going to issue the shares, whereas the cost is debited in Tata Sons because the employees have worked in Tata Sons. The main point is, sir, इधर डेबिट किसको होगा एंड सर इधर क्रेडिट किसको होगा? That is the main point. So what the standard tells is, this is a group share based payment plan. So therefore, look at the substance of the transaction. Look at the substance of the transaction. Okay. Forget stock options. भूल जाओ that there is something known as a stock option. Just forget it. Okay. Now let us consider the case like this. Tata Sons, what I'm telling is hypothetical. Okay. It should not happen, but Tata Sons does not have money to pay salaries to its employees. Does not have money to pay salaries to its employees. So what it tells Tata Motors, yaar mere ko thoda paisa de do. Can it request Tata Motors or can it order Tata Motors? What is the relationship between Tata Sons and Tata Motors? Bhai baap bete ka relationship hai. The parent will order the subsidiary, mere ko paise de do. And when it orders the subsidiary, किस हक से ऑर्डर करेगा वो? In what capacity can it order? It can order in the capacity of a shareholder. So in the capacity of a controlling shareholder, if it demands the cash from Tata Motors, it can easily say, मेरे को dividend declare कर दो. I want you to declare dividend, issue the dividend, pay the dividend to me. So with that dividend, I can pay the money to your employees. With that money, I can pay the money to my employees. And Tata Motors को झक मार के dividend देना ही पड़ेगा, because the resolution for dividend is passed by Tata Sons, who is the controlling shareholder in Tata Motors. So therefore, what Tata Sons would do for the cash is, it would collect cash, that means dividend, and distribute to its employees as salaries. The same thing is what will happen here. The same thing is what will happen here. There is a controlling relationship. हाँ, बाप बेटे में शायद रिक्वेस्ट ही चलता है आज के जमाने में, बट कॉर्पोरेट में इट इज एन ऑर्डर. ओके, पेरेंट विल ऑर्डर द सब्सिडियरी, गिव मी द डिविडेंड. सो इन दिस केस it is likely going to be a dividend. It is likely going to be a dividend. Okay, that means this will be an income. This will be an income. And in the books of Tata Motors, this is going to be dividend. That is a distribution of profits. Distribution of profits. Have you understood this? Have you understood this? This is based on the fact that, now please pay attention. Sir, ऐसा भी हो सकता है ना, अभी के लिए तो हम टेम्पररीली पैसे लेंगे, जैसे ही टाटा सन्स गेट्स द लिक्विडिटी, आई कैन गिव द मनी बैक. डेफिनेटली यू कैन. हो सकता है, क्यों नहीं हो सकता? इफ दैट इज द केस, इफ यू इंटेंड टू गिव द मनी बैक, then you can have an inter-party relationship. You can have an inter-party relationship. But ideally, parent subsidiary में पैसे का लेन देन चलता रहता है, and at the same time you will not expect Tata Motors to ask for money, and Tata Sons also will not give the money, because जो देना था they gave at the time of formation of the company. Later on जो भी movements है, generally it will be of a permanent nature. It will be of a permanent nature, and that is why it will be credited to dividend income in the books of Tata Sons and debited to dividend distribution, which goes in your reserves under in the books of Tata Motors. In the books of Tata Motors. Is it understood? Yes. Case 1 समझा अपने को? Any doubts? Any doubts? All clear. Kaushiki has confirmed it's clear. Manini, did you understand? Sumit is okay. Shailendra Singh understood. And Shailendra Singh, we can credit Tata Motors and Tata Sons debit if I'm sure that the money will be repaid back, that the adjustment will be done. But generally, these type of adjustments won't be done. So therefore, we will have to take the impact in dividends. Is it okay? Yes. Is it okay? All right, great. It's all clear. Okay. Now let us move on to another uh, case. L&T and L&T hydrocarbons. I think hydrocarbons is an unlisted entity and L&T is a listed entity. This is the parent and this is the subsidiary. Okay. Now the story goes like this. L&T hydrocarbons has employees. To these employees, L&T hydrocarbons wants to issue ESOPs. Again, the same problem. Employees will tell the management of hydrocarbons, sir, aapka share milega. We appreciate the fact that you are giving us the shares, but you appreciate the fact that I cannot sell your shares in the market. What do I do with that share? वो शेयर मेरे पास रहेगा, उसका कोई वैल्यू नहीं है बिकॉज उसका कोई मार्केट नहीं है. देयर इज नो मार्केट फॉर दोज शेयर्स which you are going to give me as ESOPs. It is just a document which you will give me which has just the value of that document and nothing else. So L&T hydrocarbons will sell. I understand your problem. I will tell my parent, मेरे माँ बाप के पास जाऊंगा मैं, and I will tell them कि please issue shares to employees. Issue shares to my employees. Okay, so now it looks something like this. L&T hydrocarbons. Where is the employee? Sir, employee is here. So employee benefit expense debit will be debited here. Acha, who is going to issue the shares? L&T. So this is going to be to SBP reserve. Now the question is, sir, किसको डेबिट करोगे आप? And यहाँ पे what are you going to credit? That dividend income will go in your profit and loss, Soham. That dividend income will go as a normal P&L item because it is dividend. Okay. All right. Tell me now. What will you debit in L&T and what are you going to credit in hydrocarbons? If you get confused with SBP reserve, etc., just think it is a normal cash transaction. I have to pay money to my employees and I don't have cash. So therefore, I go to my parent and ask for cash. So now you tell me, and this is more of a permanent transaction, not a temporary one. Okay, always it is going to be. So now you tell me, what am I going to debit? What am I going to credit? Aniket Jain, जरा सोचो आपके आंसर का. Who is holding shares in whom? Is L&T holding shares of hydrocarbons or is hydrocarbons holding the share of L&T? You will come to know whether your answer is correct or wrong. Okay, जरा सोचो. Think. 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 Can I debit dividend? Can I credit dividend? Answer is no. Dividend is not an option because hydrocarbons is not holding shares in L&T. तो हाइड्रोकार्बन नहीं बोल सकता कि यू आर गिविंग मी डिविडेंड. ओके, डिविडेंड कैन बी टेकन ओनली बाय अ शेयर होल्डर. द शेयर होल्डर इज L&T हियर. सो L&T, what it is going to give is not dividend. So what will happen is, this is nothing but L&T is making extra investment in the subsidiary. So for L&T, this is going to be nothing but investment in hydrocarbons debit. And what hydrocarbons will do? To capital contribution from parent. To capital contribution from parent. That's it. Sir, capital contribution means L&T is going to, hydrocarbons is going to give shares to L&T? Answer is no. This is another equity item. So I know it's difficult for us to even imagine aisa kabhi ho sakta hai, but it is possible because see, ultimately the genesis is IFRS. In foreign countries, you have these kind of transactions happening on a regular basis. In India, it is probably the first time that we are seeing such a kind of transaction. So this is not shares issued by hydrocarbons to L&T, but it is a long-term investment which is in the nature of investment in shares. Okay, it is a substance over form transaction. L&T will never intend to collect the money back from hydrocarbons. So it is as if it is an investment made in hydrocarbons, and for hydrocarbons, it is as if a capital contribution received from the parent. And that is why we credit capital contribution, which will go under other equity, which will go under other equity. You can debit unsecured loan for L&T and credit unsecured loan for hydrocarbons, provided there is an intention to receive these amounts and collect these amounts in the future, which is highly unlikely, Okay, so therefore it is going to be more of a capital contribution from the parent. It is going to be more of a capital contribution from the parent, and in the books of L&T, it will be like investment. It will be like an investment. Okay, so this is all about group share-based payment plans. Calculation of EBE is the same conditions, performance conditions, everything is going to remain the same. Only thing is what changes is the journal entry. I have given the journal entry to you. I have given the journal entry to you. So we will not be doing any problems on this because it's just journal entries, nothing else. Okay. So when the shares are going to be, when the options are going to be exercised, hydrocarbons will not pass any entry. The subsidiary, because uske paas to shares aayenge nahi. Employee kahan jayenge? Employee will go to Larsen and Toubro. L&T will pass the entry, SBP reserve account debit to share capital. L&T will pass the entry, SBP reserve account debit to share capital. No entry on exercise in the books of L&T hydrocarbons. Okay. By simple, जिसके बुक में SBP reserve है, that entity will pass the entry on exercise. That's it. The opposite entry party, जिसके बुक में EBE है, they will not be passing the entry for exercise because exercise के लिए employee उनके पास आएंगे ही नहीं. They will not come to them at all. Okay. So give the heading. We quickly make a note of this. Group share-based payment plan. Okay. All right. P issues shares in SBP plan of subsidiary. So in this case, it is going to be investment in S, debit to SBP reserve. And books of S, this is books of P. And in this case, it will be EBE, which goes to P&L debit, to capital contribution from parent. This is books of S. Books of S. All right. Another case, S issues shares in SBP plan of P. Books of P, EBE debit. This is going to be like dividend income. Next is books of S. Dividend, which is a distribution to SBP reserve. Okay, that's it. जिसके बुक में SBP reserve है, the entity which has the SBP reserve would record the entry on the options getting exercised. The entity recording SBP reserve would record the transaction on employees exercising the option. Okay. No entry for the same would be passed in entity recording EBE, employee benefit expenses. Okay. Are we clear? Yes. Are we clear with the transaction? Yes. Can we proceed further? I still have 2-3 small things left. I'll not be doing any question here because it's just journal entries. You can go through the questions from your study module. That should kind of help you guys. Okay. So this is group SBP plans. We then move on to the next part, that is what has come a couple of times in your exams, that is a cash plan with an equity alternative, or you can say equity plan with a cash alternative. Okay. So basically what happens here is you are getting a combo offer. You are getting a combo offer. आपको एक stock option plan दिया जाता है. In that plan, you are having the option to recognize. You are having the option to recognize to get cash or equity. Option किसके पास है? Option is with the employee. Employee gets an instrument which entitles him to two things, either cash or equity. That means what? Employee is getting something more than a regular plan. He is getting something more than a regular plan. So, for example, let us do one thing. We'll do this question with the help of an example. Okay. Just give me 1 minute. Let me look at the question. Slide 31, I think so. Okay, this is the one. All right. So now Tata Industries has issued a share-based option to one of its key management personnel, which can be exercised either in cash or in equity and has the following features. Option 1, number of cash settled shares, 74,000 with a service condition of 3 years. Option 2, number of equity settled shares, 90,000. Conditions is service 3 years, restriction to sell 2 years. Fair values, equity price with a restriction of sale for 2 years, 115. Fair value at the grant date is 135. Fair value for X0, X1 and X2 is 138, 140 and 147. Pass the journal entries. Okay. So now let us try to understand this concept with the help of this question. Okay. So first one is, what are you given? Sir, I am given a stock appreciation right. Are you given only a stock appreciation right? No. You are given a stock appreciation right plus an equity option in that. You are given a stock appreciation right plus an equity option. Since you are given two things, I will have to find out the value of the stock appreciation right separately, and I will have to find out the value of the equity option separately. I will have to find out the value of the equity option separately. The question is, how do I do that? So the standard gives a mechanism. The standard gives a mechanism. Step one, let us proceed to calculate. You are having the option of 90,000 equity shares. You are having the option to take 90,000 equity shares. But these shares come with a restriction to sell. These shares come with a restriction to sell. So can I take the fair value at grant date to be 135 in respect of the shares? No, you cannot. आपके पास shares है. This share cannot be sold for 2 years. You have to keep it with you. So do you think that a tradable share, a freely tradable share, will be lower than your value? Answer is never. Freely tradable share ka biggest advantage is it can be sold at any point of time. Whereas you, my friend, will hold this share for a period of 2 years. And therefore, there is a restriction on sale. So the fair value of that is going to be 115. So therefore, step one, equity plan. Equity plan. What are you going to get? 90,000 shares multiplied by 115. What is this 90,000? This is restrictions. With restrictions. And this fair value is also with restrictions. So this comes to how much? 90,000 into 115. 103 lakhs 50,000. Rupees 103 lakhs 50,000. Okay. So fairly simple. No problem here. Okay. Step 2. Sir, I am also getting a SAR, no? Yes, it is either this or that. So I'm having a cash plan as well. I'm having a cash plan as well. What does my cash plan entitle me? It entitles me to 74,000 cash settled shares. And this is a free plan. Bhai, aapko cash mil gaya. You get the cash. You are free to use as it is, as you want. Okay, so 74,000 will be the freely priced option of 135. So 74,000 options into rupees 135. No restrictions. And here also no restrictions. So therefore 74,000 into 135, 99 lakhs, 90,000. So your option is basically an equity plan worth 103 lakh 50,000 or a cash plan, pure cash plan of 99 lakh 90,000. So therefore the difference between this step 3 value of equity option, this is the difference between them, that is 3,60,000. So how does the standard interpret this? Is like this. The standard interprets this option which is given to the employees as a pure SAR of 99,90,000 with an equity option worth 3,60,000. Sir, how can I account for it? Can I account for it as an equity plan? Answer is no, you cannot. Why you cannot? Let me tell you. Today you record it as an equity plan. You will book 1 crore 3,50,000 in your EBE and recognize SBP reserve correspondingly. After 2-3 years, जब भी आपका exercise period starts to get due, can the employee demand cash? Definitely he can. उसके पास option है. But what have I recorded? I have recorded it as an equity plan. This will be a gross understatement of liability in the vesting period. And therefore, the standard setters have agreed to be conservative in this case. And they have agreed that since the option lies with the employee, we will be treating it as a cash plan worth 99.9 lakhs with an equity option of 3,60,000 with an equity plan of with an equity option of 3,60,000. Exactly, Kaushiki. Since we do not have the exercise price for the cash plan, it is deemed to be zero. It is deemed to be zero. So you will not pay anything. You will get entire 135 rupees. If you were given the exercise price, you would be deducting that. You would be deducting that. Okay. So that is how this goes about. Okay. That is how this is going to be computed. Is it okay? Yes. So this is fine. So it is a SAR of 99.9 lakhs with an equity option of 3.6 lakhs with an equity option of 3.6 lakhs. ये हो गया ना, this is the main thing. इसके बाद what is there is a pure repetition of what we have done. So calculation of EBE. In respect of now, two plans are there. Cash plan. Cash plan. How do I do this? Year 1, year 2, year 3. Okay. So number of employees. How many employees are there? To its key managerial personnel, एक ही रहेगा. They're not given the number. Into options per employee. How many options? 74,000. Into fair value per option. Sir, this is a SAR, so the fair value will change. 138, 140, 147. 138, 140, 147. So do the multiplication. You are going to get 102 lakhs 12,000. 103 lakhs 60,000. 108 lakhs 70,000. What is this going to be? This is going to be your total employee benefit expenses into pro rata. 1/3, 2/3, 3/3. So EBE till date कितना रहेगा? 34,04,000. This is 69,06,667 and 1,08,78,000 less recognized earlier. Recognized earlier. 34 lakh 4, 69 lakh 6,667. So EBE current year. $34,400. This is 35,02,667, and last one is 39,71,333. Have you understood the first part? Yes. Have you guys understood the first part? We have valued this now. We have taken this into consideration now. Okay. Or instead of that, I should be telling cash plan. Cash plan. Are, have you understood? Equity option. Okay, Kaushiki has confirmed. Soham and Manini also confirmed. Equity option year 1, 2, 3. Sir, equity option है ना 3,60,000. So fair value of option 3,60,000 into prorata 1/3, 2/3, 3/3. EBE till date. $360, sorry. $1,20,000, $2,40,000, $3,60,000 less recognized earlier. Nil. 120, 120. So this comes to 120, 120, 120. EBE current year. Okay. So now the question is, bhai ye to ho gaya mera expense. So every year, what is the expense you will record? 34 lakh 4 plus 120, 35 plus 120, 3971 plus 1,20,000. So if I have to plot my journal entries, they will go something like this. Year 1, year 2, year 3. EBE debit to SBP liability to SBP reserve. So liability in the first year was 34 lakh 4 and reserve was 1,20,000. Second year 35,02,667, 120. Third year 39,71,333, 1,20,000. So this comes to 35,24,000, 36,22,667, and this comes to 40,91,333. So this is how you are going to record. And ultimately this EBE flows to the P&L. Okay, I'm sorry. This is, thank you, Kaushiki. 2,40,000. Okay. Impact is the same, but I'm just looking at the time. We have spent a lot of time. Okay. So this is correct. Yeah. So 1,20,000. Okay. So this is the entry that you are going to pass. Exercise day period. Exercise period. On this date, beginning, I am having SBP liability 108,78,000, and I am having SBP reserve rupees 3,60,000. Both are credit. Okay, itna hai apne paas. Okay. Yeah. Thank you. Thanks, Manini. Yes. Okay. So now let us assume that this option is the employee exercises the cash alternative. The employee exercises the cash alternative. So in that case, how am I going to do the accounting? Assuming cash alternative. The entry will be, वो कैश मांगने आएंगे, आप कैश दे दोगे, so SBP liability debit to bank. You will pay that 74,000 options into 147. Option बचते हैं इसके बाद? No. So therefore, this is 74,000 options into rupees 147. What are you going to do with the reserve? Sir, abhi to option nahi rahe na, so you transfer it to retained earnings. Transfer it to retained earnings for 3,60,000. 3,60,000. 3,60,000. Excellent. Assuming equity alternative is exercised. Equity alternative. Sir, वो equity exercise करेगा. That means he is not exercising the liability. That means you are going to get consideration for the equity shares which you issue in the form of a liability that is foregone. Please pay attention. Normally, for equity options being exercised, आपको क्या मिलता था? You would get cash. But here you are not going to get cash. Instead, the liability of 1,08 lakhs is going to go away. Because once you give him equity, he cannot again come for cash. So the consideration for equity is the liability that is getting foregone, is the liability that is being extinguished. Okay, the liability which is being extinguished. So the entry is going to be, now pay attention. Liability जाएगा, so SBP liability debit. SBP liability debit. Can he come for equity also, cash also? No, that he cannot come. So 1,08,78,000. SBP reserve also will vanish because it is getting converted to equity. So 3,60,000. 2. Equity share capital. How many shares? 90,000 shares into rupees 100. Just assuming. Okay. Assumed. So 9 lakhs. To securities premium. Balancing figure. To securities premium 20. Okay, 9 lakhs 90,000. This is 90 lakhs. Sorry. And this is going to be 1 second, please. $22,38,000. Okay, to securities premium. All right. So this takes care of the transaction. Okay. Here we have taken the fair value because there is no what you can say exercise price which is given, Soham. There is no exercise price which is given. That is why he will not pay anything. Means nothing will be deducted. Entire fair value will be paid to him. Okay. So initially what we have recorded basis that only we do the settlement. Okay. To securities premium 22,30,000. Assuming face value of 100. Acha, there is an alternative which is there in your study module. There is an alternative. Okay. Let me just show you. 1 second. Page 5.50. Okay, so this is the solution which your study module has given for the equity alternative. SBP liability 1 crore 8 lakhs we have debited. They have taken share capital and share premium. Okay. And the SBP reserve is transferred to retained earnings. So this is what is printed in your study module. I'm not saying this is wrong. Okay. See, first of all, understand why this answer is not wrong. The standard gives you the guidance in this way. When the SBP liability or when the SBP option is exercised, any balance that is left in the SBP reserve has to be transferred from one component of equity to another component of equity, which is exactly what is being done here. So this answer per se is not wrong. Okay, I'm repeating, this answer per se is not wrong. If you go by a very liberal and interpretation of Ind AS 102 in spirit. But if you look at my solution, which I have just now presented, I have also moved the SBP reserve from one component of equity to another component. From SBP reserve, I have moved to securities premium, which is another component of equity. So what is the difference? See, the difference arises in the fact that when I have SBP reserve to retained earnings, the reader may slightly get confused by the fact that is any option lapsed? What is the details of lapsed options? How many are lapsed, etc., etc. Those kind of questions will arise because of this entry. I'm again saying it's not wrong. It's just that it gives some more questions to ask by the reader of financial statements. Instead, if he looks at this entry, he will come to know that the equity alternative was exercised and therefore entirely the SBP reserve account also has been added to securities premium. There is no lapsing of the options that has happened. So only for that limited perspective, this answer is slightly different as compared to what is there in the study module. But again, I repeat, study module answer is not wrong. Those of you who want to still choose to present in this way, they may be doing that. Okay, this is an alternative answer. But if I was in your place, I would still say that this is a better presentation. Okay, this is a better presentation. Okay, because this does not leave any scope. In this case, the equity option is not utilized, and that is why it goes to retained earnings. So this is clear. But in the case of equity alternative, again, मैं यही entry रखूंगा, then the reader may get slightly, confused. So just to avoid this, I have chosen this. But per se, again, strict reading of standards, I am telling openly that this answer is correct. Okay, there is nothing wrong. It's just that this entry is a little more logical. Okay, so anyways, that takes care of cash settled with equity alternatives. Okay. This is concluding. Then we have two small concepts. I'll just discuss the theory with you. One is cancellation. Sir, can these stock options which are issued be cancelled? Yes, they can be. Okay. So if they are cancelled, how does the standard treat the cancellation? How does the standard treat the cancellation? Well, cancellation is treated as immediate vesting. See, when you cancel an option, when the company cancels a stock option, it is breaching the terms of the contract. And because it breaches the terms of the contract, it is deemed as if the options are immediately vesting. So, jo EBE we would proportionately prorate. We will entirely prorate in the period of cancellation. We will write off the EBE entirely in the year of cancellation. At the same time, because the company has breached the terms of the contract by cancelling the stock options, it will be paying some cash compensation. In cancellation of options, there will be a cash compensation which is paid. So cash compensation up to the fair value on the date of compensation, we will adjust it from the SBP reserve, and anything extra will be taken to the profit and loss as a loss on cancellation. Okay. I know I have hurried it, but it's fairly simple. Cancellation means breach. Breach means you cannot say that cancelled means the company benefits. Company cannot benefit from it. So whatever EBE you have been deferring, you will recognize it entirely in the year of cancellation. Step one. Second, you have breached the contract. So you have to compensate your employees in cash. To the extent of fair value on the date of cancellation, you can utilize the SBP reserve. And the balance, whatever is left, you will take it to the loss on cancellation. You will take it to the loss on cancellation. So this is the impact for loss on cancellation. Just 1 second, please. Let me just run through the theory at least of this question through the what you can say slide. 1 second. 20. Just a minute, please. Just give me 5-10 minutes, then I'll conclude this. Okay. All right. Page 5.66. Okay, so we run on to the next part. Okay, so Anara Fertilizers issued 2,000 share options to its 10 directors for exercise price of 100, required to stay for 3 years. So 130 rupees fair value, expected number of directors 8. During year 2, there was a crisis and management decided to cancel the scheme immediately. Estimated further that fair value of option was 90, market price of share on the date of cancellation was 99. There was a compensation paid to directors, only 9 were currently in employment. At the time of cancellation, it was agreed to pay an amount to rupees 95 per option to each of the 9 directors. How would this be recorded? So you can just have a look. First one is we record the expenses. So 8 directors expected to vest at the beginning of year 1. Cancellation I did not know. Into fair value 130 into number of options 2,000. So 20,80,000. It is expected to spread over a 3-year tenure. So 6,93,000 would be the first year. Second year you cancelled. So whoever is there, they would be getting the full compensation. So it is as if this is vested in the second year itself into 130 into 2,000. So entire 16,46,000 I will record it in the second year. Sir, are you giving the option? No, I'm not giving the option. I'm giving something more than the option. So therefore the EBE also will come, plus the cancellation compensation also is going to come. So record this entire expense here, and cancellation compensation is going to be 9 directors into 95 into 2,000, 17,10,000. Out of 17,10,000 on that date, on the cancellation date, the fair value of option is 90. So 9 into 90 into 2000, 16 lakh 20. So out of 17 lakh 10, 16 lakh 20 can be met from SBP reserve. You have a reserve of 23 lakh 40,000. You have a reserve of 23 lakh 40,000. 23 lakh 40 may say you can meet this 16 lakh 20. Balance you can transfer it to retained earnings, and this 90,000 loss goes to the P&L. You cannot say I will use entire SBP reserve, because you have to show in the P&L you have made a loss on cancellation, which is the truth. Why have you paid 95 when the fair value is 90? It means you have paid more because you have breached the terms of the contract, and that is why we have to show that as a loss on cancellation, and that is why it's taken to the P&L. Whatever is paid up to the fair value, meet it out of SBP reserve, no problem. But usse zyada jo hai, that will be a loss on cancellation. So this is loss on cancellation. Last part is modification. Can options be modified? Yes, provided it is for the benefit of the employees. So benefit of employees means what? Benefit of employees means that the incremental fair value is positive. Sir, what is incremental fair value? On the date of modification, you will compare the fair value of the revised option with the fair value on the date of modification. That increment, if it is positive, it's beneficial to the employee. You will record it as a new plan from the date of modification. From the date of modification. Initial plan continues for its entire life. Modified plan will be treated as a new plan from the date of modification. How will I record the expense? By using the incremental fair value. What is the incremental fair value? Fair value of modified plan on the date of modification minus the fair value of the original plan on the date of modification. That is known as your incremental fair value. That will be the basis for calculating my modified plan expenses over the remaining period of the plan, and basis that we will be recording the expenses throughout. Okay, so my sincere request to you is please try 1 second 5. Please try this one question today. 20 slide number. This one question, I want you to try it today. Okay, November 2019 RTP question. Just try this today. Tomorrow, later part of the standard, means tomorrow I start with EPS. Later part, that means towards the end of tomorrow's class, I will extend a little bit. That time I will be discussing this question. But my sincere request is please try this out, because modifications shayad aa sakta hai exam mein. It's not yet come so regularly, but it can come in the exam. So I want you to guys to try this one question today. Then I will explain the solution and the flow tomorrow. Okay. So that should kind of conclude the modifications part also. Cancellation I have discussed. So that concludes our discussion on Ind AS 102, except for that modification, which we'll be discussing tomorrow. Tomorrow first we'll be starting with Ind AS 33. A disclosure standard, which is important in terms of computation, but debit credit nahi rahega. Lot of maths and maths related calculations. Okay, so see you guys tomorrow. Have a nice Saturday and take care of yourselves. I'll be troubling you again on Sunday morning. Okay, so we'll be discussing it on Sunday. Thank you, everyone. Thank you. Okay, thank you. Thank you, Ayaz.